Warriors of price action and guardians of fundamentals, welcome to Retail Recon. On today's mission, we light the first flame of technical analysis. We're going back to the most basic building block of any price chart, the candlestick. The objective is simple: understand what a single candle really tells you about the battle between buyers and sellers, so you stop guessing and start reading the story in price. So gear up and let's go to work. Before you worry about patterns or fancy indicators, you need to understand one thing. A single candle is a complete mini report of what happened in a specific time window. Every candle shows you 4 pieces of intel: the open, the high, the low, and the close for that period. Whether it's a 1-minute chart, a daily chart, or a weekly chart, the candle is just telling you where the battle started, how far each side pushed, and where it finally settled. Let's start with the body of the candle. The body runs from the opening price to the closing price. If the close is above the open, you get a bullish candle. Most chart platforms color this green or white. It means buyers won that round. Price ended higher than it started. If the close is below the open, you get a bearish candle. Usually this is red or black. It means sellers won. Price ended lower than it started. When the body is very small, it means the open and close were near each other. Neither side really dominated. That's often a sign of hesitation or balance, not clear control. Now look at the wicks, also called shadows, the thin lines above and below the body. The upper wick shows how high the price traded during that period before being pushed back down. Think of it as the territory buyers tried to capture but couldn't hold. The lower wick shows how low the price dropped before being bought back up. That's the area sellers tried to push into but buyers pushed them out of. Long wicks tell you there was a strong attempt that failed. A long upper wick with a bearish close says buyers pushed hard but sellers counterattacked and won the close. A long lower wick with a bullish close says the opposite. The same logic applies on every time frame. A 5-minute candle and a daily candle show the same 4 prices: open, high, low, and close, just over different lengths of battle. The higher the time frame, the more weight each candle usually carries. A strong daily candle at an important level means more than a noisy 1-minute candle in the middle of nowhere. Before getting lost in complicated names, focus on the basic types. A strong bullish candle, large body, little to no wicks, buyers were in control almost from open to close. A strong bearish candle, large red body, small wicks, sellers dominated the entire period. An indecision candle, small body with wicks on both sides, neither side had clear control by the close. These single candles become much more important when they appear near key areas like support, resistance, or major moving averages. A strong rejection wick at a known level tells you more than the same candle in the middle of a trend with no structure. Let's now walk through a simple example and see how to read the candle step by step. On the screen, you have a chart of RMS and I highlighted one candle. When you look at any candle, follow a simple protocol. Start with the body. Did price close above or below the open? Who won this round? Buyers or sellers? Check the wicks. Who pushed further but failed to hold? Was there a strong rejection above or below? Look at the location. Where does this candle sit relative to recent price action and key levels? Is it breaking through an area, bouncing from it, or just drifting in the middle? Based on all 3 segments, what do you think about this example candle? Bullish or bearish? If you answered bullish, you're spot on. First, the candle has a large green body signaling the bulls won and the price closed well above the open. Second, the bottom wick is very small, signaling there was very little push to the downside. The trading on this day practically went one way only. And finally, the trading started below a 150 moving average and it closed well above, signaling the crossover a major key level. Never forget, one candle alone is just a small piece of intel. Don't base your decisions solely on that. Read the full story and use a string of candles to form your opinion. Many retail traders get burned by misreading candles. Some common traps. staring at one candle in isolation and making big decisions without any context. Treating every little wick as a signal instead of understanding that some of it is just noise. Trading long-term goals of very small time frames, reacting to 1-minute candle while their plan is based on weeks or months. Candles are tools for clarity, not for overreaction. The goal is to see structure, not to chase every tick. Candlesticks are the first flame of technical analysis. One candle gives you the open, high, low, and close, a short battle report between buyers and sellers. The body tells you who won the round. The wicks show you the failed pushes. The context tells you whether the battle actually matters. If you found value in this mission, lock in your support by liking, subscribing, and following our movement. Thanks for standing watch with me today, and until next time, trade smart, risk sharp, and stay on target.